Duolingo is down 82% from its all-time high. The stock went from $545 in mid-2024 to $100 today. 10 Wall Street analysts have downgraded it in the last 90 days. But the company just put up 35% revenue growth, crossed $1 billion in annual bookings, has $1 billion of cash and zero debt, and is still adding users at a record pace toward a 100 million daily active user target by 2028. So which is it? Deep value setup or value trap? Today we find out. Welcome to the Money Mind. Today we are doing a solo deep dive on Duolingo, ticker DUOL. We're going to walk through the valuation, including one massive accounting asterisk almost everyone is missing, the Q4 earnings crash and why the street flipped from buy to hold, the balance sheet strength, the big deceleration in bookings, the competitive picture, including AI, and finally the bull case, the bear case, and the verdict. Let's get into it. First, what is Duolingo? It is the largest language learning app in the world, with about 53 million daily active users as of late 2025. The owl mascot, the streak counter, the bite-sized 5-minute lessons, that is Duolingo. But the company has expanded beyond languages into math, music, and chess. The Moat has never been the curriculum. The Moat is the gamification layer on top. Think of Duolingo less as a language school and more as a habit app, like Strava or Apple Fitness. That happens to teach languages. The streak is the real product. At the Friday close of $100.51, the market cap is about $4.7 billion. Now the crash. On February 27th this year, Duolingo reported Q4 2025. The quarter was strong by almost any measure. Revenue hit $283 million, up 35% year over year. Full-year bookings crossed $1 billion for the first time ever, but the stock fell 23% the next day. Why? Two reasons. First, management guided 2026 bookings growth to 10 to 12%, a massive deceleration from the 33% bookings growth just a quarter earlier. Second, revenue was guided at 15 to 18%, which sounds better, but here is the catch. Bookings is cash collected today. Revenue is recognized over the life of a subscription, so bookings is the leading indicator. If bookings growth falls to 11% today, revenue growth follows to that level 12 months later. The market saw the bookings number and priced in the trajectory. Now here's the valuation asterisk you will not see in most Duolingo videos. If you look up Duolingo's trailing price to earnings ratio on a brokerage screen, you will see about 11 times. That looks insanely cheap for a 35% grower. It is not real. Duolingo's full year 2025 net income was $414 million. But $257 million of that was a one-time tax benefit from releasing a deferred tax asset valuation allowance. In plain English, Duolingo had been carrying past operating losses as a footnote on the balance sheet. When they achieved 10 straight quarters of profitability, accounting rules let them flip those losses into a real asset. That flip ran through the income statement as a giant one-time gain. Strip it out, and normalized net income is closer to $157 million. That puts the real trailing price to earnings ratio at about 30 times, not 11. Honest framing matters. 12 times earnings was the bait. 30 times is the truth. That said, the balance sheet is genuinely pristine. Duolingo has about $1 billion in cash and investments, zero long-term debt, zero financial debt of any kind. The only liabilities on the books are deferred revenue from prepaid subscriptions and operating lease obligations. Think of it this way. At a $4.7 billion market cap with $1 billion in cash, you are essentially paying $3.7 billion in enterprise value for the business, with $1 billion war chest included for free. That enterprise value on normalized earnings is about 23 times, which is more reasonable. The practical benefit of this balance sheet is optionality. No dilution risk, no refinancing risk. Management can buy back stock, make acquisitions, or just keep reinvesting in growth without ever touching the capital markets. So, what has Wall Street been doing since the Q4 crash? Cutting. Hard. Over the last 90 days, consensus earnings estimates were slashed 5% for this quarter, 20% for next quarter, 11% for the full year, and 17% for next year. The analyst buy camp shrank from 13 analysts to 4 in 90 days. 6 formal downgrades landed in a 3-week window around earnings: Morgan Stanley, JP Morgan, Evercore, Citigroup, Scotiabank, and Argus. That is the kind of coordinated capitulation that usually happens near the bottom of a D rating, not the beginning. And the critical detail: the cuts have basically stopped. In the last 7 days, only 1 down revision per horizon. No sweeps, no capitulation, no new bearish reports. The pot that was on a full boil is now at a simmer. Here's what management is actually doing. They are deliberately slowing monetization in 2026 to focus on user growth. The goal is 100 million daily active users by 2028. From 53 million today, that is roughly 23% annual DAU growth. Why slow monetization on purpose? Because engagement is the compounding variable. A bigger, more engaged user base eventually monetizes better than a smaller one that you squeezed too early. Think of it like a restaurant choosing to give away appetizers for a year to pack the dining room, with the bet that the full tables will eventually spend more on entrees and drinks. That is a real strategic bet. It is not moat erosion. It is a deliberate reinvestment phase. The risk is obvious. If remonetization does not materialize by 2027 or 2028, this looks less like Amazon's investment era and more like a consumer app past its peak. Who competes? Traditional players like Babbel and Rosetta Stone, now owned by IXL Learning, are stuck targeting serious academic learners and losing the engagement war. They are not the threat. The real competitive question is AI. Can ChatGPT, Gemini, or Khan Academy's Khanmigo do what Duolingo does, better and for free? The honest answer is nuanced. For free-form conversation practice, yes, a general AI tutor can already beat the structured Duolingo tree. But for habit formation, streak psychology, and bite-sized daily lessons, AI chat is not a substitute. The streak counter is the moat. AI is great for a learner who wants to practice. Duolingo is great for a learner who wants to show up every day. Those are different products. Management has also embedded AI inside Duolingo itself through a feature called Video Call, where premium subscribers can practice conversation with an AI tutor. So the company is absorbing the AI threat, not being replaced by it. So here is the bull case. 1. The balance sheet. $1 billion in cash, 0 debt, pristine. 2. The estimate bleeding has stopped. After 3 straight months of cuts, the last 7 days have been nearly silent. 3. The mode is engagement, not curriculum, and AI cannot easily replicate the habit loop. 4. The 100 million DAU goal by 2028 is credible given current momentum, and every net new engaged user compounds the moat. 5. The forward price to earnings ratio is 12, and the forward PEG is about 0.85, which is cheap on any reasonable growth scenario. 6. The street is overpositioned bearish. 18 hold ratings versus 4 buys is a distribution that flips fast if Q1 bookings come in even slightly above the 10 to 12% guide. The bear case is just as credible. 1. The bookings deceleration from 33% to 10 to 12% is enormous. It is the kind of reset that often marks a structural change, not a one-year transition. 2. The forward PE of 12 relies on significant margin expansion, from 15% operating margin today to closer to 30%. That is not trivial. 3. The 100 million DAU target requires continued low-friction growth, and user growth in consumer apps rarely stays smooth. 4. AI is a moving target. Today, Duolingo is absorbing AI. Tomorrow, a new entrant could attack the gamification layer itself. 5. The price target distribution tells you something. Mean target of $105, median of $100. The street is literally pricing 0 upside over 12 months. That is a vote of no confidence, even from analysts who are not bearish enough to sell. So is Duolingo a buy at $100? My honest take: this is not a fat pitch. It is a reasonable risk-reward for a patient investor who believes the streak moat holds and the 100 million DAU story plays out, understanding that the valuation argument hinges on margin expansion that is not yet proven. The technical setup is interesting. The stock is trading right at the 50-day moving average and well below the 200-day. A bounce off these levels with the revision picture stabilizing would be a classic sentiment reset setup. The balance sheet means you're not going to get zeroed out. The moat is real even if it is narrower than it was 4 years ago. The Q1 print in early May is the next catalyst. If bookings come in above the 11% guide midpoint, this re-rates quickly. If bookings come in below, it keeps bleeding. Not financial advice. Always do your own research before investing. So that is Duolingo at $100, down 82% from all-time highs, with a pristine balance sheet, a street that has given up, a bookings number that scares people, and a DAU story that most investors have stopped paying attention to. If this breakdown was useful, hit subscribe. Tell me in the comments if you think 100 is the bottom or just the next leg down, and we will do the Q1 earnings reaction the moment the numbers hit the tape in early May. I'm the Money Mind. Let's keep building.